Hi, and welcome to the next edition of the Chipotle Valuation Series example that I've been putting together. One thing that I'm going to ask real quick, if anybody is watching these and you're getting any value from them, please go ahead and give a thumbs up or put a comment or something on there so I can see if I'm just wasting my time developing these. But if you are watching the videos and getting anything worthwhile out of them, please let me know and I'll be glad to keep the series going. I'm going to finish this series anyway, but I can do more valuation analysis discussions later on if this is something that people are getting any value out of. Now, in the previous video, we forecasted the income statement, and that's kind of where we wrapped up. In this video, we're going to be forecasting the statement of cash flows. Now, we had to start with the income statement because the first line in the statement of cash flows is net income. We need to start with net income in order to get the cash flows. Why cash flows? Well, my valuation philosophy, remember, is based on the idea that when you buy a stock, you're buying the piece of a company. And therefore, if you want to know what the stock is worth, you should know what the company is worth. And in finance, one of the main philosophies that I believe strongly is that the value of any asset or any company is equal to the present value of all the expected cash flows that that company is going to generate over its lifetime. Now, there are some huge problems there because you're trying to forecast cash flows not just for next year, not for 2 years, but for the life of the company. And you're going to introduce a lot of error in that process. And we've talked about that before. We'll talk about it again. But remember that your valuation is going to give you a precise but incorrect answer. That's the false precision concept. So once you get a valuation, you should stop and first of all compare it to the market price. Is it close? If so, you're probably on the right track. If not, it doesn't mean you're on the wrong track. If not, what you want to do is then double check your model. Make sure your assumptions make sense. Make sure your formulas make sense. I've done models before where I get them set up and I realize that I made an error in setting up a key formula. And once I fixed that, it changed the results dramatically. So do spot check relative to the market price. If you're off the market price, that may represent an opportunity, but don't assume an opportunity at first glance. Assume that you probably made a mistake somewhere in your model, the assumptions, the calculations, the formulas that you used. It's probably far more likely that you made an error there than the market is wrong. But sometimes the market is wrong. Sometimes the market overvalues stocks, sometimes it undervalues stocks, and that's the whole point of this valuation analysis. So let's get back to this particular Chipotle example and look at the statement of cash flows. So we start with the previous 3 years, 2017, 2018, 2019. That is historical data. Those are the actual numbers from Chipotle's 10K that we can record. And you should probably write down the previous 3 to 5 years of the financial statements before you start building your financial model. That's going to give you some framework and give you a feel for how these numbers play out. Now, normally I take the model from the income statement and the statement of cash flows and follow those pretty closely. I did not do that for Chipotle, and let me explain briefly why. So in the statement of cash flows, to get to net cash from operating activities, I actually only have 3 line items: my net income, depreciation and amortization, and then other adjustments to operating cash flows. Other adjustments to operating cash flows include things like changes in accounts receivable, changes in inventory, changes in accounts payable. Lots of different things can show up in there. Now, if there are only 3 or 4 or 5 items, it might make sense to forecast those individually. However, let's take a look at Chipotle from the 10K and their statement of cash flows. If we look, their first line item is operating income, our net income. That's our starting point. The next line is depreciation and amortization. That's a very important piece. Remember, depreciation and amortization are non-cash expenses. They've lowered our net income, but we're not really paying anything for those. So we want to add those back to our cash flows. However, let's look at how many line items they have in their adjustments. So we have depreciation and amortization. That's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18 different items here listed in our statement of cash flows. Now, if you want to forecast 18 different items, you're welcome to do so. My prior expectation is that in doing so, you're going to create more of a headache than it's worth. You're not going to gain that much precision, and you're going to introduce a lot more opportunities for error. Now, some of those errors are going to cancel out. You might overestimate the change in accounts receivable and underestimate the change in inventory, and those errors will balance out. Or you might overestimate accounts receivable and overestimate inventory, and they won't balance out. So we have to be careful about that. What I decided to do in my model is to just group all those things together. I separated out depreciation and amortization because I think that's a really important key separate factor. And then all the other items I just lumped together in other adjustments to operating cash flows. So the depreciation and amortization, that was something I forecasted from my income statement. So I just pull that straight from there. The net income is also pulled straight from the income statement. So those numbers I've already forecasted. The new one that I'm forecasting is other adjustments to operating cash flows. And you can see that is over on forecast tab P8. So let's take a look at that. P8 is my 204,418. Where am I getting that number from? Well, what I did is took a 3-year average as a percentage of sales. So I summed up that row from my cash flows for the 2017, 2018, and 2019, divided by the sum of sales for that same 3 years, and found that to be 3.56%. Now, how reliable of a number is that? Well, let's look at the last 3 years. We have roughly 3%, 5%, 3%. So you can see it's not like it's jumping to 10%, down to -5%, to 2%. It's not moving all over the board. It's fairly consistent in that range of about 2 to 6%. I'm comfortable with this as a 3.56% forecast. Now note, I can change this if I want, so this is a starting point. As with anything on here, that's the beauty of an Excel spreadsheet, is you can really easily do what if analysis, make some changes and see how things flow. So I used this as my adjustments to operating cash flows. That's taking care of accounts receivable, inventory, prepaid revenues, which are the gift cards that they sell, all those other things, all wrapped up into one line item. So my net cash from operating activities, I just add these three things together, and that gives me my net cash from operating activities. $775.7 million is their net cash from operating activities. However, remember, Chipotle has to reinvest in stores. If they're going to grow, they're going to open new stores. They're going to have to make sure their existing stores are up to date. Some of it may be relatively simple investments. Some of it may be redesigning the kitchen. So they're going to have expenses in updating existing stores as well as opening new stores. And if you're looking at restaurants, one of the key factors for growth, remember, is opening new restaurants. So Chipotle is going to grow by A, increasing their same store sales, and B, by increasing the number of stores that they have. If they can get their same store sales to grow by 5%, and they can increase the number of restaurants or stores per year by 5%, those combined give them 10% growth. So you can really magnify your growth by opening new stores. Now remember, there is a limit to that. If Chipotle has stores in every major location and most minor locations, there's not a lot of value to adding a new store. If there's a Chipotle one block away from the next Chipotle, probably not a lot of value added in having both locations. But if it's the first Chipotle in a new mid-sized town, there might be a lot of value added in that. So we have to look at how many opportunities there are for growth, but that's going to be where their capital expenditures are going to be coming from. So where am I getting my capital expenditures? I take forecast P4 times the income statement. So I'm doing this as a percentage of sales. There's not a perfect way to estimate that. Sometimes people will try to look at statements by management guidance. A lot of times you can get good guidance as to what they expect capital expenditures to be for the next year or two. Sometimes they'll state that in a dollar value. Sometimes they'll state it as a percentage of sales. They usually don't go beyond the next year or two as far as their guidance, but they can give you some idea of expectation. For me, let's go see forecast P4. What I did is looked at capital expenditures per year over the last 3 years, and that was about 5%, about 6%, about 6%. And then in 2020, I lowered that to 5%. Why did I lower it? Well, do you think Chipotle is probably moving ahead, opening new stores as planned in 2020? Or they may be cutting back a little bit? My guess is they're probably cutting back a bit. Remember, we're in the midst of the COVID-19 pandemic. Most of Chipotle's are in the US, and there are lots of areas in the US that are really struggling as I record this. Remember, it's July 2020. And so most likely Chipotle is cutting back on their capital expenditures. My guess is they're still opening a few new stores, but probably not as many as were planned. Now, you could argue that I should bump this up going forward, and I think that would be a legitimate argument. Maybe it should go back to 6% in 2021 and beyond. We can do that later. So again, this is a simple, I just put the first forecast in and carried it across. You can fine tune your model very easily if you want to. So now let's go back to our statement of cash flows. Next categories are purchases of investment and maturities of investment. Now, if you look over the previous 3 years, what you'll see is that by and large, these are kind of balancing out, not necessarily on a year-to-year basis, but if I go to 2017, they had more maturities than purchases. If I go to 2018, they had more purchases than maturities. If I go to 2019, it was pretty close. So my assumption is that these are just going to cancel out going forward. I don't know. I don't really have an ability to predict how much they're going to spend on purchases, how much they're going to spend on maturities. By and large, my take on this is that those are going to cancel out, which means there's not going to be any net cash flow impact. So my net cash from investing activities is just going to be how much are they spending on purchases of leasehold improvements, property, and equipment. And so I've got that forecasted out for the next several years. Then we've got net cash from financing activities. This is where you would see dividends paid, you'd see stock buybacks, you'd see stock issuances, you'd see new debt issued, you'd see old debt that was paid off. All those things show up. Now, Chipotle doesn't have any long-term debt, so I'm not going to see any new debt issued. I'm not going to see debt paid off. Chipotle also doesn't pay dividends, so that's going to minimize what's going on in their cash flow from financing activities. Where this is really important is if you see companies that have a fair amount of debt. One of the things to remember about the statement of cash flows is that interest expense is going to show up at the top line, cash from operating activities. That's part of their net income, but debt repayments are going to show up in cash from financing activities. So you want to be careful and look ahead. Do they have any big maturities coming up? Usually in their 10K, companies will break down how much debt they have and when that debt is due, especially debt that's due over the next couple of years. So it's 2020. A lot of companies will tell you how much debt is due in 2020, how much is it due in 2021, 2022, and so on for the next maybe 3 to 4 or 5 years. And then after that, they'll say additional debt due and lump that all together. So you're not going to get perfectly precise year by year debt maturities, but you will get a good idea of what those debt maturities are. If you have a company that has large debt maturities coming up, one of the things to be careful for is, do they have the ability to either A, pay that debt off, or B, refinance that debt? If not, that's going to be a major problem. So you want to be really careful in those situations where companies do have large amounts of debt, and make sure you acknowledge that in your cash flows. Are they generating enough cash flows that they're going to be able to pay that debt off? Or are they going to be able to refinance? If not one of those two things, then you want to be very careful with that stock, because there's a good chance they're going to run into some debt problems when that debt becomes due. Again, we don't have that issue in Chipotle. So ultimately, I get down here to free cash flow to equity. And one of the things that Chipotle is not doing, they're not paying dividends. I didn't model any buybacks into my thing. So if you look at acquisition of treasury stock, that's Chipotle buying back shares of stock. Historically, 285 million, 161 million, 191 million. I've got zeros all the way here. And the reason for that is, it doesn't matter to me whether they're buying back shares of stock or paying dividends. What matters to me is that they're generating the cash flows. So in my model, Chipotle has the ability to generate $488 million in cash flows in 2020, 561 million, 645 million, and so on. Again, I forecasted through 2027. There's no real where's the correct point to stop. If you've got a company that's growing at a very steady rate and you don't expect them to grow much faster or much slower over time, probably the next 3 years is sufficient to forecast out. If you've got a company that's growing very fast, you want to think about, how far out do I go? Now, one reason to carry that a little bit further is, if you've got a company that's growing fast and you expect them to continue to grow fast for the next several years, you want to be able to account for that on a year by year basis. You don't want to lump that into the constant growth rate. That's a big place where people can make a mistake. The reason for that is to remember, the constant growth rate is saying that's how fast the company is going to grow each and every year forever through the end of time. So let's say the economy is growing at 3% a year and your company is growing at 5% a year. Is that realistic? Well, sure it is for the next 5 years, for the next 10 years, next 50 years, it's probably even realistic. But eventually, what's going to happen? As your company grows faster than the economy, it's going to become a bigger and bigger and bigger portion of the economy. And finally, you run out of room to grow. So if we look, for example, at Walmart in the 1980s, they were growing very rapidly. They were opening new Walmarts in quite a few new locations, and they had tremendous growth. Walmart's growth has slowed dramatically over the last decade. And the reason for that is Walmart has stores in most major locations, so it's difficult for them to continue to grow. If you grow at a higher than normal pace, you're going to see one of two things. One, you're going to continue to be successful until you saturate the market. Or two, you're going to invite competitors. Other people don't sit on the sidelines and say, wow, that's a really good idea. We wish we would have thought of that. Oh, well. Instead, they say, hey, somebody's making lots of money. I'd like to make lots of money too. And they jump in and you have new competitors. Now, to some extent, you can hold competitors at bay through economic moats, things like barriers to entry or patents or really high entry level costs, things like that. Those things can help keep customers or keep competitors away, but ultimately you're going to have to defend those moats, and that's going to cost some money as well. So we tend to see companies can grow faster than the economy for a while, but not forever. One way to incorporate that is to have a longer forecast period and allow the growth to gradually drop over the forecast period. So I'm going to stop this video. We've got one more, which is going to be a lot shorter, and it's just going to walk through our valuation models. Thanks.